have to understand the game, and you have to understand that it's normal for stock prices to drop. They don't always go up to the right. That's unusual.
You look
And
at a
it's okay.
stock, it's up 50, 100, 150%, and you ask yourself, do I need to lock that in? Like, do I need to lock those gains in before they disappear? We all do it, okay? It's fine. Like, we want that gain. We want to lock it in. What if you looked at it differently?
They all set their lives up to be successful, not based on money, but based on fulfillment, like how they enjoyed the game.
Your point, having that mindset helps you, like it's an advantage that you don't even realize that is helping you every single day.
All right, folks, welcome to Investing for Beginners podcast. Today we have episode 380. Today we're going to talk about some things that you can learn from our friends Warren Buffett and Ben Graham. So I came across this great quote, and I thought this would be kind of the great foundation for us to chat today. So here is the quote. So the basic ideas of investing are to look at stocks as businesses, use market fluctuations to your advantage, and seek a margin of safety. That's what Ben Graham taught us. 100 years from now, they will still be the cornerstones of investing. And again, this is a great Warren Buffett quote. So maybe let's talk a little bit about Uncle Warren and Uncle Ben, and maybe explain their significance in the world of investing and why anybody should really care.
Yeah. Benny, rest in peace.
Right.
Both of these two gentlemen have paved the path when it comes to looking at the stock market and looking at your role as an investor in a completely different way. Definitely a way that had never been looked at before they came around and really popularized it. For example, the idea, like in the quote, of looking at stocks as businesses instead of just tickers that you trade, or the other ideas they had about the stock market itself and how it behaves. Those were radical ideas, and who better to show that those ideas worked than the buff dog himself, Warren Buffett. Took, I don't know, what was it, like $100,000 or something, and now he's worth 20 billion, 30 billion, whatever the number is. It's a lot.
Yes.
And so he took Graham's teachings and showed that this is what's possible. And he did it through companies that we all know and recognize today. Coca-Cola, American Express, Apple. These are all companies. Geico was a big one for both Graham and Buffett. Huge winner for both of them. So not only did they teach these really groundbreaking ideas, which they're really rooted in fundamental principles that I would argue you can apply not just to investing, but they align with a lot of just older principles, fundamentals, but use that to generate lots of wealth for themselves. And so it's very inspiring and something to learn from.
Indeed it is. And I think the thing to me that is kind of amazing is that Graham wrote his book Intelligent Investor, what, in the 30s and 40s, somewhere in that time frame.
Yep.
And it's still relevant today. Those ideas that you were talking about they were revolutionary at the time, and they've become synonymous with how people invest, in particular in value investing, which has really taken hold. Buffett popularized it, and it's really become one of the, probably maybe not the largest way that people invest, but certainly in the top 5 in the way that people invest. And the idea of fundamental analysis and understanding that you own a piece of a business was groundbreaking. We have to think about back during Benjamin Graham's time, they had ticker machines that would print out these little pieces of paper that had the stock symbols and the price. And that's how a lot of people could track how their stock market was doing until the next day, when they could maybe look in the newspaper if the information was provided in that particular episode, in that issue, dating myself there. And so it was the idea of a company like, what was the steel company that was super popular? It's like huge back in the day.
Can't be there.
Yeah. Sorry, I'm blanking on the name of the company.
Like Carnegie's thing.
Yeah. Right.
Yes, yeah.
It's, The name will come to me around 3:30 this morning, so I'll let everybody know then.
Right.
But
Thanks.
uh, the idea that you were buying a piece of the company was definitely revolutionary, and a lot of people don't know this, but Warren Buffett actually studied with Ben Graham at Columbia University when Ben Graham was teaching a fundamental analysis investment class at Columbia. And then after he graduated, he actually worked for Benjamin Graham for a period of time before he went off on his own. And so he had a huge impact, Graham did, on Warren Buffett. But you could also say that I think Warren Buffett had an impact on him as well. And it's just really interesting to see. And these guys both kind of set the groundwork, and Buffett really, and along with Charlie, have really moved the movement forward. I don't think that we would probably all be investing the way that we are now if those two had not really been the trailblazers and the groundbreakers during that period of time. So that even if you don't invest like a Warren Buffett or a Charlie Munger or a Benjamin Graham or any of the value investing legends, it doesn't mean that they haven't had an influence on your style of investing. I've talked to a lot of growth, air quote, growth investors or quality investors, and a lot of the same principles that Andrew and I follow and espouse are very similar to the kinds that they do. So they've really had a huge impact, and it's partly why we talk about them so much, is because they've had a huge influence. They're very smart, and they really kind of set the groundwork. Plus, they're fantastic investors. So, I mean, all that combination really kind of sets us up.
100%.
So let's maybe talk about why, like, when we think about viewing stock as a business, like, what does that mean to you?
Well, the basics obviously are you go to the stock market to buy shares, which represent partial ownership of the huge corporations around us. And that's inspiring to know that as an everyday Joe, I can go out and participate in some of that. In another way, I think it's also makes this idea of building wealth more accessible and possible because like the average investor is probably not going to compete against a hedge fund in trying to split the pennies of like a high frequency trade or figure out the commodity derivative to the 10th degree and be able to spot the weather changes and how that applies to 5 cents in the price of oil. We're just not going to compete in that realm. But being able to be a part owner of a business over a very long time where all the owners together get rich slowly but steadily over time is achievable. And that's what can happen if you look at finance, stock market, investing from that lens rather from the other finance, Wall Street investing lens, which can be cutthroat, ultra competitive, very difficult to find an advantage, all of those things. And so to me, as I look back and reflect of what makes investing so exciting, why is the opportunity to buy a piece of a business so appealing? I think that's certainly a big one for me. How about
Yeah,
you?
yeah, for sure. I think when I think about the ability to buy a piece of a business, I think about the best way to generate wealth is through the ownership of businesses. And if you look at the top 10 richest people in the world, they all own a business in one way, shape, or form. If you look back on history, they all have owned a business in one way, shape, or form. Even a guy named there was a Roman. His name was Crassus, and he was alive during the time of Julius Caesar. And at the time, he was considered the richest man in the world, and he owned businesses, and that's how he became wealthy. And so the idea of owning a piece of a Tesla, a Microsoft, a Google, a Meta, Nvidia, any of these companies that I can't, I'm not smart enough to go out and do what Jensen Huang did or what Mark Zuckerberg did. I don't have that in me, but I can partake in what they have done and get wealthy on my own off of their backs. And that's to me what having stock ownership in a real business really indicates. And so to me, it's kind of a no-brainer to just I own a part of Google, and I'm going to let Sundar Pichai do all the heavy lifting, and I can just sit back and worry about whether the stock is going to go up or down or not. I don't have to worry about all the other stuff. And so, to me, that's the exciting part of the stock market. Is I love learning about businesses, and then being able to partake in the success of those businesses is very appealing to me.
What are some of the advantages that come with that kind of mindset of, okay, I'm going to be a owner?
To me, it sets up this idea of long-term value versus the short-termism that you can certainly see in social media and is sometimes very evident in the stock market. And the way that these people have all gotten wealthy is by owning their businesses for a very long period of time. Jensen Huang has been doing his thing for 20 some years. Meta now has been around since, 15 years, something like that. And that's even before they went IPO. Microsoft has been around for 50 or 60 years. And so all these companies that we think about, that the way that you get wealthy is by owning them for a long period of time. Yes, you can get lucky and buy whatever company that ascends very quickly, and you air quote time the top and sell out quickly, but that's a lot harder to do. And we only see we see their survivorship bias. We only see the successes on social media. We don't see the hundreds of millions of people that don't time the top right in that kind of short-term idea. And so to me, it's really the advantage comes to having a long-term mindset and having an idea that I'm going to own this company for a long time, and that's how I'm going to build my wealth. What are your thoughts on that?
Yeah, totally agree. And if I could only pile on a few other things, is just you can really get burnt by getting that short-term mindset and trying to figure that out as you're buying stocks. And we all still face that. We all want to feel smart and feel like we bought a dip, right? Or even when you're selling something, I want to be the one who sold right before it crashes. We all are going to fight that. But to your point, having that mindset helps you, like it's an advantage that you don't even realize that is helping you every single day.
Mm-hmm.
Like it's just you're giving yourself an inherent advantage, and it helps your behavior. It can help what you focus on, and yeah, it has lots of advantages.
Yeah, it certainly does. Do you know any investors, like off the top of your head, that have kind of been successful by adopting this kind of mindset?
All of them.
Yep. Right.
Like I can maybe count on my right hand how many investors didn't do it that way and really traded their way to success. The big famous investors,
Right.
a lot of those, almost overwhelmingly all of them look
Mm-hmm.
at stocks as businesses, and they kind of all have their own style of what they look for and what types of businesses they tend to find success in.
Mm-hmm.
But yeah, that's a universal trait that's shared, is this idea that, yeah, I'm buying partial ownership in a business and I'm holding that for the long term, and I'm okay if there's volatility, if the price goes up and down. In the meantime, I'm fine with that.
Yep. Yep. For sure. I mean, sometimes I think about William Green's book, Richer, Wiser, Happier. He talks about a wide range of different kinds of investors. And to your point, a lot of the characteristics and mindset and the way that they invest is kind of similar. There's like a theme across the board. They all are buying shares of businesses. The idea is to try to hold them for as long as they can. They all have different flavors of how they like to do that. Tom Markel does it differently than maybe Nick Sleep does, who does it differently than Monish Pabrai does, versus Joel Greenblatt and Charlie Munger. So, but they all have very common characteristics, and that kind of having that ownership, long-term mindset was really one of the major themes that kind of seemed to run through the river, if you will, of the book, and that really jumped out to me.
Yeah. What else did you like about that book as it pertains to this whole idea with the Buffett and the Ben Graham thing? Anything else jump out?
I think one of the major things that I really liked about it was they all set their lives up to be successful, not based on money, but based on fulfillment, like how they enjoyed the game. One of the things I took away was, guys like Joel Greenblatt, it wasn't about just money, amassing more money. It was about the game. It was about and setting his life up so that he could enjoy the game without the stress of the other parts of investing. And I really felt like that's what Nick Sleep did as well. I think he was probably the best at that. Was he really set up his life to I'm going to do what I do, and then everything else is not going to relate to this. And he wasn't in it for money. I mean, these guys all were wealthy, so it's maybe a different different playing field. But I really liked how they set up their lives to benefit from what they enjoyed doing. What about
Yeah.
you?
Yeah, that's awesome. I liked a lot of the part of the book, and if you haven't read it, go read it.
Yeah.
But that's definitely, I love that insight. Like,
Mm.
how are you going to stay into the game if you don't enjoy it? At some point, you got to burn out,
Yes.
unless you enjoy it.
Right, for sure. Moving on to, I guess, the next air quote part of Buffett's quote, he talked about market fluctuation. So, like, maybe let's talk about what market volatility is and how we can look at it as an opportunity as opposed to a threat. So, what are your thoughts on that?
It's very hard.
Mm,
I mentioned the way that Buffett and Ben Graham look at the stock market itself. And Ben Graham outlined it in his book, The Intelligent Investor. He called it Mr. Market. So
mm,
you imagine a guy who's a bipolar maniac who every day brings you a piece of a business. And depending on what mood he's in, he's like, here, you want to buy this business for $80 or you want to buy it for $150? So if you look at the stock market in that way, it actually, you can start to look at it in a different light, because sometimes the volatility can make you feel, and it's very much a feeling, like, what am I not getting here?
mhm,
What's happening behind the scenes at this company that's down 30% that I'm just not privy to? Sometimes it's valid, but most of the time it's just Mr. Market being Mr. Market. And
mhm,
so we can find opportunity in that, because if Mr. Market offers you a price that doesn't make sense, but he's just in a bad mood, then as an investor, we can take advantage of that. And that can just turbocharge the compounding that we get from being owners in these businesses.
mhm. Yeah, exactly. I always like to think of it as market volatility is a feature, not a bug.
Oh,
And
yeah.
it's really the way, because it's a complex system, all these crazy humans all buying and selling companies, that it can offer up opportunities. Like you said, Mr. Market, I think, is the perfect analogy for the craziness of the market. Some days, he can show up at your door and offer you great deals, and other days he can offer you trash. And we have a choice of which to choose. But I think if you view it as an opportunity as opposed to a threat, your mindset will be different. And you have to understand the game, and you have to understand that it's normal for stock prices to drop. They don't always go up to the right. That's unusual. And it's okay for things to see drops. I don't know how many of you, everybody raised their hand, maybe not. Whenever I buy a company, it automatically goes down. So I've just gotten used to it. And it's just like, okay, heads up, guys, I'm buying some, I'm buying some NVIDIA. It's going down. So to me, that's normal. But it doesn't mean that I can't take advantage of it. So how do you think about trying to buy undervalued stocks during a downturn, like, air quote, buying the dip? Like, what does that mean
Mhm.
to you?
Well, I've observed for myself, and I hope this changes about me, because I don't think it's beneficial to think this way. When I see a dip in a stock and I don't own it yet, it's very easy for me to be like, this is the time.
Mm.
Let's load up. Yes. I don't know all of its warts up close after owning something for a while. But when something I've owned for a while dips, it's much harder. it's much
Mm,
harder to double down on that.
mhm.
And there's been times for sure popping in my head, like Dick's Sporting Goods. I even think one of the members in Value Spotlight like made a comment about that. Like, fair, you were right. You
Right.
know, I should have doubled down. So that's something it makes it very hard. Like
Mhm,
when you start to mix emotional attachments, this idea that a stock usually looks better or business looks better from the outside. And then once you actually start to own it, you be like, oh, this is kind of like all my other stocks, right? So it's very, very hard, but that can be a way if you can get over that, which
mhm,
is not natural, but I believe it's a muscle you can work on and you
mhm,
can get better at. If you can start to do that, then the number of opportunities that you'll be able to pounce on will be even greater.
mhm.
So I don't have the silver bullet for that. I would love to hear if you do, but it's something I'm actively working on.
Unfortunately, I do not have the silver bullet. I am still struggling to find said silver bullet. I love that Buffett quote where he says, "When you can always tell who's swimming naked when the tide goes out," kind of thing. And I think about that in relation to trying to buy companies that have fallen for whatever reason. And my biggest struggle is more not necessarily related to whether it's a newer company or in my portfolio. It's more of anchoring. Like if I
Mm,
bought it, let's say I bought, a company at $100 a share and I see it drop to $75 a share, I'm more likely to pounce on that than
mm,
if it drops from, let's say I bought it at 100, then I bought another tranche at 150 and then it drops to 125.
yeah,
Because I'm anchoring on the 150, not the 100 that I
right.
bought. And so that's the thing that I struggle with. And it is a muscle, I agree. And it is something that I'm actively thinking about and try to push past sometimes, because one of my biggest challenges along with that anchoring is also is averaging up. So as a great company continues to improve, obviously the value of the company changes too, but I'm still anchoring on what I bought it at originally. And so but that's something that I'm actively trying to work on to move past. And it's not easy, but I think the way any of the ways that you can think about trying to improve on those biases, I think is going to make you a better investor in the long run.
100%. I love that. You know, when you mention this idea of like it's very hard to average up.
Mhm.
I was in the car with my wife and talking to her about something, and she said something that like just made the wheels start turning, right?
Mm.
And it's like it's one of those ideas that I'll probably never pursue, but I'll share it and maybe someone will find it helpful. We always look at a stock, and especially if you're new, you will, I almost guarantee you will do this if you're brand new. You look at a stock, it's up 50, 100, 150%, and you ask yourself, do I need to lock that in? Like, do I
Mm.
need to lock those gains in before they disappear?
Mhm.
We all do it. Okay. It's fine. Like, we want that gain. We want to lock it in. What if, what if you looked at it differently in that, oh, I bought, let's say it's Costco, instead of saying, "Oh, Costco's up 70% since I bought it." What if you said Costco has added 50 warehouses since I bought it? You know what I mean? To
Mhm.
put it in that owner mindset. I'm sure FinChat probably has a feature to do that already, but
Probably.
you know, just to whatever that KPI is, to put yourself in that framework to say, I'm a part owner of this business. If the business has gotten bigger, I don't need to lock that in. It's already happened. It's already
Mhm.
still going on. So it's very unlikely that those 70 warehouses that Costco just expanded to are going to all of a sudden shrink down to zero and now you have no
Mhm.
gains. It's very unlikely. So if we can start to think that way, then you look at those gains in your portfolio differently. I'm not saying it will help you with averaging up, but maybe with the like wanting to sell to lock in a profit.
Mhm. Yeah, I love that, and I think that's kind of brilliant because it goes back to what we were talking about at the beginning. I think part of what I'm doing is I'm anchoring on the price or the ticker, not the business. And so what you're talking about anchors more on that business And if you think of it, like you said, like an owner of the business, then that's a different way of approaching the company. And of course, if a great company is improving, you want more of it. And
Yeah.
so, I mean, that's the way it should be.
Yeah.
So I like that. I like that idea. I'm actually going to lock that in the memory bank.
Cool. Well, you better, because I don't have any left. Any memory banks left.
Mine's getting a little full too. I might need to do a data dump here at some point. Can you think of like any examples from history where like volatility has maybe benefited a savvy investor?
Yeah, I mean, the buff dog, obviously,
Yeah.
locking in. He's like, what is he? I don't know. He's not undefeated, but he's like the Tom Brady of doing that.
Yes.
No offense if you hate him.
Yeah.
You're allowed to be wrong. He's a goat.
Right.
Um, he did it with American Express. He did it with Coca-Cola. And if you look, and it's amazing. You zoom out of those charts, and it's like, there's a dip. Oh, there's Buffett. Okay, and then it goes back up.
Yeah.
That's crazy. But yeah, he was really good at doing it. And I'd be curious to know why. I feel like he doesn't talk about that particular thing very much. I don't know if it's like it would be humble bragging, but if he hasn't answered it at an annual meeting, that'd be a great question for him to ask. Like,
Yeah.
how are you so good at doing that consistently?
Right. Yeah. It's not. And the other thing about it is it's not like he's taken a lot of swings.
Right.
So it's not like his batting average is, 275 for something like this. It's 800. And so he just chooses his spots really, really well. And how he does that, who knows?
Yeah.
That's probably a secret he's probably going to take with him to the grave. But yeah, I'd if I could ever ask him a question, that would probably be high on the list.
It shows it's possible.
Yeah, that's very true. It's very true.
It's not exciting. It's kind of boring. But what we offer is a free ebook and email series at stockmarketpdf.com.
All right, let's move on to the last part of the question or the quote. And this is talking about the seeking of margin of safety. So you and I have talked about this in the past. Let's define to you, what is the margin of safety and why is it important?
I think there's several ways to interpret margin of safety, and I don't think any way to interpret that is wrong. Finding safety in your investments, or finding a margin, a buffer, just in case things go wrong, is always a good thing. If you can find it, if it's available. So margin of safety, usually when I use that term, I'm talking about the valuation of a stock. So if and when you find stocks that have a nice valuation margin of safety, then it becomes the Manish Prabhai, heads I win, tails I don't lose much. You can think of it, if a stock trades between the floor and the ceiling and you're buying with a margin of safety, you're probably buying that stock close to the floor. And so it's so depressed, Mr. Market's so down on it, it probably won't go any lower, because at some point people are going to look at it and be like, this thing's so cheap, like you're almost getting cash for free if a stock drops low enough. I'm starting to get into dangerous territory with that statement. Profitable companies that are growing, that see their stock drop. Okay, now we're good.
Yeah.
So that's one way to look at margin of safety. Do you have thoughts on the valuation margin of safety, or a different way, completely different way to think about margin of safety?
No, I certainly agree with the valuation part of it, and that's what I normally associate a margin of safety is by determining the intrinsic value of a company that you want to buy and finding a dislocation between what you think it's worth and what the market thinks it's worth. And obviously the greater the margin, the more margin of safety you have in case you are wrong on your estimates of what the margin of safety could be. Other maybe a little bit more esoteric or ethereal ideas of margin of safety could involve things like portfolio construction, like how much of it you actually buy, whether it's part of a diversification strategy. The company that you're adding to your portfolio, if it's unrelated to all the other things in your portfolio, that's a part of a margin of safety. I think it's always a great idea to look for the value in a company and see if the price is different. I always try to associate it with things I can understand, like buying a car, or buying shoes, buying a house. All those things we all want them on sale. And that's what I always think of a margin of safety is when you're buying a company with a margin of safety, that means it's on sale. Meta is probably one of the more recent great examples of that when the company's price dropped to 80 some bucks a share. And now it's, I don't know, 400, 500 bucks a share, something nuts like that. But it was out of favor. And there was a lot of negativity around Zuckerberg and the company. And that provided an opportunity for a margin of safety if you bought it at those prices. And now you look like a genius because it's, 400% up or whatever crazy number that is. To me, I always associate it with like valuation. That's like the primary way of looking at it. And that's the way that's the way I've always used it, has been that method.
Yeah. Yeah, for sure. Definitely not as popular of an idea as it
No.
used to be.
No. It definitely, back in the early Buff Dog days, it was, very much a big thing. In today's investing world, it can be looked upon as old school or out of touch, out of date kind of thing, especially when you see markets like we have now, which you could argue how frothy, bubbly, whatever term you want to throw on them. The idea of, I posted a few things about valuation the other day on Twitter, and I had a few choice comments about like, this doesn't matter. Don't listen.
Really?
Don't listen to this. It's, you don't need this kind of thing. And so, I mean, like you said a minute ago, free to be wrong. But it's whatever works for you. I mean, that's really what it comes down to. And to me, calculating the value of a company, I think, is part of fundamental analysis, and it should remain so, irregardless of whether the market thinks that it's overdue or past due.
That reminds me of the crypto bros in
Oh yeah.
2021 who said like, have fun staying poor.
Right. Yeah.
Yeah.
Right. Yeah. People commenting on, Buffett, like, what was it? Some 22-year-old has been investing for 6 months, and it's the Buffett is past his prime kind of thing. Okay. Sure. Sure.
Are there any practical tips or ways you would recommend people start to go down that path if they don't know, like, how do I find a margin of safety? How do I determine that for a stock I'm interested in?
Well,
how does somebody go down that path?
The first thing is you got to identify and figure out what is a company you want to buy worth. And there's two main ways to do it. One is you can use what's called relative valuation, which basically means you take familiar metrics like price to earnings, price to free cash flow, price to sales, things of that nature, and compare the company you want to buy to other companies in the same industry and find out if they're, air quote, relative expensive or cheap based on others in the same industry. That's the most common way that especially analysts use to value companies, and it's a good shortcut if you don't have a lot of time and don't really understand the other one, which is more it's along the lines of a discounted cash flow model. And those are the ones that Andrew and I kind of are big fans of and use the vast majority of the time. And they can be, it sounds complicated, but Professor Oswald de Motoren, who's the GOAT of teaching this stuff, said that any investor, regardless of what level they are, can do a DCF. It's just a matter of figuring out what the inputs are and learning how to find that information, and then you can utilize them. So it looks and sounds like higher math. It's really not. And generally, you only need 5 to 6, maybe 7 inputs to figure out a value of a company. Keep in mind, it's not perfect. No valuation method is perfect. We have created a ton of resources on our website, e-investing for beginners. It's also part of Value Spotlight, which is our subscription service. And then I also have a free DCF email series that I created that can help you learn how to use a DCF in 7 emails. And so if you're interested in that, you can follow the links in the show notes and you can sign up for that. And so those are easy ways that I have done myself to try to learn how to value companies. So I guess, what are your thoughts on this important idea?
I 100% double down, triple down. Like those are the ways to go if you are stuck.
Mm.
Like literally, let's not overthink it. Like that's the path. Pick which one you want to go and go.
This is
It's
the way.
interesting. This is the way. It's interesting to me. You said you and Brett were chatting about the inputs for DCF are the same every month. So once you, the more and more you practice, the less you have to learn, and then the more mastery you get, because it's not like you're learning a new language every month or something.
No, not at all. I was just watching. You kind of clued me into this. I've always been interested in physics. It's always kind of intrigued me. I don't really understand it, but I was watching this video from Veristasum. Yeah, I think that's it. Sorry if I butchered that. But anyway, this guy on YouTube was going into the theory of relativity and explaining how space-time works and everything, and I was just like blown away. But after watching it for a while, I started to kind of get it. And I'll go back and watch a video again, and I'm sure after the second or third time, I will probably at least understand how it works and how the theory works and how black holes work and everything. And to me, that's kind of the same idea when you're trying to learn something like this. The theory doesn't change and the inputs don't change, but you do have to, use your judgment over time. And the more reps you put in, the better you'll get at it, for sure.
So if I'm falling in a black hole, are you able to pull me out?
No, I am not.
Oh,
Light does not escape at black holes because it doesn't move fast enough. It has to move faster than the speed of light, and it does not move faster than the speed of light. So,
okay, you lost me. I fell.
Derailed. So I guess to kind of like wrap up our conversation for today, how would you suggest like newer investors, maybe even experienced investors, kind of embrace this idea that Buffett was trying to teach in his quote, and how could people, I guess, get better at this?
Yeah, answer a question about a quote with another quote. And this is from his late partner, Charlie Munger. He said something to the effect of try to get smarter every day. And something I've said before that has really resonated for me personally. I think I've said it several times on the show, but this isn't quite write it on the wall or put a sticker on it moment. So I'm happy to share it again. If you really think about it, investing is a lifelong journey. You're probably going to be an investor until you pass. So with that in mind, obviously life is short, but at the same time, a lot of us will live a while. And so there's not a huge rush. This isn't like a hobby that you need to master over a weekend because you want to impress your friends on the golf course. I have no idea what that would feel like, but it's not like that. It's something that you can take your time, you can grow a little bit every day. And as your knowledge compounds, your skills can compound and your results can compound. And like we mentioned in the beginning, I mean, these businesses, if you're doing it in this way where you're looking at stocks as businesses, it takes them a long time to grow. They don't just grow overnight. Be patient and understand that it's just going to be a longer process. And I think there's a good chance you'll get to where you want to go. So that's going to wrap us up for today. We hope you enjoyed the show. If you have questions, comments, feedback, concerns, we always love to hear them. Newsletter at einvestingforbeginners.com. Connect, learn, and grow with Value Spotlight. Peace.